Hello traders, welcome to this live intraday strategy webinar on SB Trade Desk. Today is Wednesday, July 6th. Michael Boutros here with you this morning. Great to be with you guys. Eileen, Graham, Hussein, Madad, Mir, Pooja. We got the whole crew in today. Good to be with you here, guys. We just got the release of some US data trade balance figures. Not expecting too much from it. Here's what it looks like. You got a contraction or a deeper deficit than expected. We were looking for a print of 40 billion, on a deficit side. It actually came in at 41.1 billion. That's surpassing the 37.4 billion we got previously. More importantly, later today, you will be getting the market services PMI. And obviously, the highlight of today is going to be the FOMC policy meeting. So before we get into that, I just want to show you a quick relative performance as we get started here at the session of what the dollar looks like to open up U.S. trade. So you have a split performance here. If you look at the dollar index, it's as clear as mud from where we are from a trading standpoint, okay? Not close to support, not close to resistance, right mid-range for the monthly range we've set so far. Performance today is really mixed all over the place. You got the yen with a nice rally of 1% plus. Aussie a little unchanged on the session. We're looking higher there. I'll talk to you about that in a moment. Swissy and Euro also seemingly unchanged on the session. Biggest loser, though, is going to be the is going to be the Kiwi dollar, down 0.59%. Okay, and CAD and sterling down 0.5% respectively as well. So you got a split performance, leaving the index a little bit off today. Remember, this specific index, the Dow Jones FXCM index, is Euro, Aussie, sterling, and yen. So the widely most traded, most liquid currencies versus the dollar. So it won't necessarily reflect weakness that we're seeing in CAD, won't necessarily reflect weakness that we're seeing in New Zealand, and certainly the index here pretty lackluster. One other thing I did want to go over, and we'll look at a couple of these today, but if you look at the interest rate expectations, Fed fund futures, you're continuing to see the probabilities of a hike just drop off the side of a planet here. If you recall, you can go back, by the way, on SB and just type in WIRP. It's going to bring up the latest interest rate probability. So here's what it'll look like on the 14th. Okay, you're looking at a 51% chance for a February hike. Now February is down to 5.9. So everyone completely kicking out those expectations for any type of interest rate hike from the Federal Reserve. Now, as that stands, a lot of the bid that you're seeing for the dollar here is largely on risk-off trades because of what's been going over in risk assets. Obviously, you guys have been noticing, if you've been watching the headlines, you've continued to hear how U.S. Treasuries have continued to make all-time record lows. That's like the fear factor coming up in the markets. Remember, Treasury yields will move inversely with price. So as investors crowd into the relative perceived safety of U.S. Treasuries, the yield will continue to decline. So with that being said, it's important to understand the dynamics of what's really pushing and pulling the dollar here. Not necessarily at interest rate expectations any longer, but certainly some of the risk-off flows that we've seen. And I think that's also apparent in gold, which made a massive breakout today. We'll talk about that in a moment as well. But moving forward here with the U.S. dollar, heading into the interest rate or the FOMC minutes later this afternoon, it's important to keep in mind we have already gotten, the gist of where Yellen stands. Okay, we've already gotten the presser where she really highlighted the main concerns that are plaguing the central bank at this point. The employment numbers won't necessarily be a game changer. Obviously, the May numbers were abysmal. Okay, only came in at 39,000, I think, or 38,000. Don't quote me on that, but something in that region. And certainly, that does put a hamper. The Fed's dual mandate is price stability and maximum employment. So from the employment sector, we're a little bit on shaky ground, which is why this Friday's non-farm payroll print is likely to be absolutely paramount. Okay, if we snap back in non-farm payrolls, we're expecting a print of about 180,000. If we snap back from that 38,000 print earlier, likely to see some of those concerns really subside. Okay, if you start to see a weaker than expected print on non-farm payrolls, anything sub 150, you'd likely see some of those concerns from the Fed started to be mounted. That being said, that's Friday. So the minutes that we're going to be reading today at 2 p.m. is just a reflection on what they spoke about last month on the 14th and 15th. So specifically, we'll be looking for concerns as it pertains to inflation, which has been the most um, troublesome, let's say, factor for the Fed. We'll be looking for any type of underlying concerns about the labor market, and obviously the main thing we'll be looking for are concerns with regards to Brexit, how many people voiced those concerns, how serious those concerns are, and obviously global growth prospects. So the devil's in the details. Again, this is not going to be a release like non-farm payrolls, better or worse than expected. Market moves. We're really going to have to dig in. Try to keep you updated on SB Squawk as that release comes out, but do be mindful of that at 2 p.m. Barring any type of extraneous comments with regards to concerns over China or the Brexit or anything, I don't necessarily think today's going to be a game changer, but we'll have to see what the minutes reflect. Okay. Obviously, tomorrow morning, don't forget, right ahead of the start of the webinar, we do get the release of ADP employment change, looking for 160,000, down from 173. ADP employment is simply the private sector read, where the non-farm payrolls is going to be the more encompassing government read. A lot of people like to use this as a gauge for what we'll be seeing in NFPs. But what I do want to note is that ADPs, while they largely do move with non-farm payrolls, they are notorious for missing larger swings in the headline NFP number. So they broadly will move together, but if NFP prints out of 38,000 like we got last month, what was ADP last month? 173. Okay, so notorious for missing larger gaps in the ADP number, which obviously will be a little bit more of an encompassing number from the government. So keep that in mind tomorrow morning at 8:15 a.m. The FOMC minutes, they're live then, so can cover Brexit impact and not just putting together last month. No, Eileen, the minutes are the exact recording of what was discussed at the June 14th to 15th meeting, rather. There's nothing new. There's nothing new. So remember, this is pre-Brexit, right? Yep. Yep. So that's why it might not be that much of a tell, right? Because there's a lot of developments that have happened, obviously, since the FOMC announcement. But if you look at the interest rate expectations like we just did, markets are pretty well, adjusted and priced in the fact that we're not going to really see an interest rate hike again this year. Okay, so let's jump right back into price action. Here's what the dollar index looked like. Like I said, a little bit lackluster here to start off the week. As I said, if we had gotten the drop early in the week into this key support, this swing high from last month, the median line, I would have been interested in a long. If the overnight rally had extended into 1206, like we noted yesterday, I would have been interested in a short. But here we are, falling short of resistance, falling short of support, momentum holding sub 60. I still like the idea of dollar weakness. Now, whether this thing tries to make a rally back towards that 1206 level before we turn around, I don't know. And I'll be looking for price action to give us a little bit more of a tell. On its face value, it has broken above the monthly open that you see here in purple, and we're now checking that as support. So on a basic hold, you're at near-term, interim daily support right here. Okay, if we get that last stretch, like I said, area of exhaustion interest, area of short interest. If we do get the break lower early or later this week, wouldn't necessarily try to buy off this line, but I'd be looking for a possible break there to really give us a little bit more of a conviction downtrend in the dollar index. Remember, as we noted yesterday, seasonalities here are certainly bearish for the dollar moving into the start of July trade. Amir says, "Hi Mike, hi everyone in the room. I might not be there through the entire webinar, but if you can kindly go through sterling yen with all possible supports, fib, MLs, and all possible indicators. If not during the webinar, then maybe you can post it on SB Squawk later. Thanks, and I truly appreciate it." Hey, Amir, no problem, man. I'm going to jot that down. We'll definitely go through sterling yen. Look, sterling dollar just came off of a massive region. I don't know if you saw. Hey, Amir, you're more than welcome, man. I appreciate that. I don't know if you saw that tweet from Jamie, but let's take a quick segue before you leave the webinar here. Here's what the sterling looks like. We'll come back to the updates from last night in a moment. Here's what British pound looks like. And I guess on this one, you kind of just need to look at the weekly chart. But huge region. And guys, this was all mapped out earlier, right? We talked about all these levels. If we go back, you got to go quite a ways back. And like I said yesterday, you will not get information this far on market scope only goes to 1993. If you do want to see previous price action for the British pound, check out tradingview.com and type in sterling dollar FX IDC, which is just a different feed. It goes back much longer, but you have a lot to look at here. And the primary thing that almost caught the low, almost to the pip, is going to be a basic 786 retracement of the 1985 advance. Okay, so you're talking about a fib that's what, almost 30 years old? Okay, so that 786 comes in at 2797. Add to that basic trendline support, extending off the low from 1993 and the low from 2001, right there. Add to that basic channel resistance. Take a couple of parallels off the high from 2009, that swing high that we made back in August, converges right down there. So this thing is coming to a huge, huge region. Now, one thing to keep in note is that momentum on a weekly basis is dipping into oversold territory. It's not where you want to start calling bottoms. See, last time we dipped into oversold territory, this thing saw the biggest decline. That was back on the onset of that 2014 drop-off. And as long as it stays in oversold condition, the propensity for this thing to keep going is there. I want to see some bottoming. I want to see a cross back above 30. But we are on the lookout for more rigid support here. This is a pretty massive region for sterling dollar. Amir says, yeah, I saw that tweet. All right. Yeah, so keep that level in mind. As it pertains to pound yen, I don't have such a clean setup here for the daily charts, but let's see what we got. Bear with me one moment. Oops. Sometimes it's really fruitful to go back on these longer term charts just to get a gauge of where the broader market is trading at. Okay. Not a bad hold there. Okay. Well, as far as trend lines are concerned, as far as the median lines are concerned, you've kind of broken down all those levels. I don't have anything near term on this. The only thing I would look for is either a pivot back above basic channel support. I'm extending this off that low that we made, the swing low for February, Amir. And near term support on the downside for this, you still have a little bit more room. Okay, you have that 88.6 doesn't come into 125.89. Yeah, this is what I'd be looking at for the weekly chart. This is what I was looking at for a weekly chart. The big break that you saw here, um, Amir, would have been right here. This was sort of the major break. Median line is the 50 line of the descending formation. The key 618 retracement of the entire advance off that 2011 low. And momentum deep into oversold territory. So if you're holding shorts on this one, I'd be bearish below the weekly opening range high. Looking for a stretch into 125.89. Amir, I'll take a closer look at the near-term prospects for this one. And if I come up with anything, I'll definitely put it out on SB Squawk, okay? It's a very interesting trade. I've been very mindful of pound yen because ATR is just massive, guys. It's just massive on this one. So you really want to use some caution here, especially on near-term trading. You want to cherry pick those entries. If you're holding shorts, like I said, I'd continue to favor the downside against this week's opening range high. Okay. So if you have any specific questions, Amir, do let me know. Again, like I said, I'll take another look at this and see if we can have something a little bit more for the near-term price action that's going on. Back to the updates from last night. Here's what we were looking at on the Aussie dollar. So, as I noted last night, we were coming in some support. Amir, you're more than welcome. I was holding a long off this one, as I noted in yesterday's piece. We hit both those targets at 74.50 and 74.70. At this point, you might get some teetering out, some exhaustion to the open of U.S. trade, but I still like the trade, still like the bias. I'm looking for re-entries on the long side. Here's what euro dollar looks like now. Or excuse me, Aussie dollar looks like now. Okay, so let's start off with just the daily chart. Really clean. Obviously a very similar situation with the dollar index is that we didn't stretch into resistance per se. I was loving a rallying to 75.70 for a possible short. But the decline in overnight trade coming into a real sweet spot. Now, I'm not going to lie to you guys. I got stopped out on the initial entry here, and then I jumped right back in. Big region of support. You had the 100-day moving average, the 50 line of the descending formation off the highs, the 50 line of the ascending formation off the lows, and certainly the monthly open was right there. You saw a brief dip below an overnight trade before coming back up. Now, here's what the 30-minute looks like. It's a little bit different. It tells a little bit different of a story. So your monthly open and weekly open come in at 74.48 into 74.50. That was the initial target for the long exposure. Now that we've crossed back above that, and again, this is the gap, not from this week per se, because we filled it already, but the gap from last week, which offered some resistance on the initial break into the close of the week. So we're now crossing that level. That was 74.70, the second target from last night. Okay, so initial target, secondary target. I still like it higher. Initial entries now heading into the U.S. trade session, if you're not already, long, is for a look back to a pullback into this region. Again, the monthly open / weekly open, or the median line that you're looking at here. Okay, this is basic channel support. And if you zoom this out, take a 2-hour or a 4-hour here, might be easier to see. If you zoom this out, this slope is origined from these two reference points. You probably say to yourself, well, Mike, why are we still using that slope if you got some break here, you got some break here? It's very simple. If you take this slope, take the parallel to the low that we made post-Brexit, you caught some really nice lows there. And again, little messy here, but nonetheless holding that major support. And that 50% retracement also offering some further conviction on that near-term support bounce. So here we are with the rally, momentum with a nice defense of the 40 level. It's exactly what you want to see. And I'll be looking for this thing to teeter out. I'd be looking for the pullback to get back on the long side, targeting the upper parallel. Okay. Levels haven't changed. Topside targets beyond here, 75 is just that swing high. The 618 comes in at 75.16. So 75.04 into 75.16, this 11 pip range right here. And then the upper median line parallel. Amir says, why you're not publishing your trades? I'm sure you got this question 100 times before. So Amir, for near-term trading, it's nearly impossible. I mean, unless I'm sitting at my desk undisturbed all day long. These trades on a near-term basis, guys, they're not just simple buy here and sell here like a medium-term swing trade strategy. Sometimes we're adding to the position on the breakout. Sometimes, you're taking off a small portion, take off a quarter here, take off a quarter here. I would literally be scalping and just tweeting all day long. So the other side of that is that there's a lot of different ways you can play these same setups. You know what I mean? A break of the initial opening range here for Asia last night could have been a short opportunity into support. And I don't want to sort of deter anyone from playing those levels. The bottom line of it, Amir, is I give you the levels, we give you the bias and the invalidation levels, and the intraday action should sort of speak for yourself. This webinar is geared towards giving you highlights of what's happening in the session ahead and the levels that we're looking at in the main setups that we're following. So I hope that answers your question. It's just not feasible for something so near term. Trust me, I've tried. But feel free always, guys, for you guys to reach out at any point. You know, we try to be as accessible as possible to you guys at all times. And certainly we're watching these markets all day long. Any questions on the Aussie? As far as Aussie data is concerned, you're cleared for the rest of the week. The major event risk obviously is going to be the non-farm payroll print on Friday. But broadly looking to stay constructive while above that channel support. Questions on Aussie? One thing to take note of is that we looked at Aussie dollar at the Sunday update as well. And one thing I just wanted to note is we went over this yesterday. But again, interest rate expectations continuing to plummet. If we take a look at the overnight index swaps for Australia, continuing to plummet. Okay, ahead of the RBA, we were looking for September as the possible probability for a cut coming in at 55% essentially. Look what happened in September now, 63%. Okay, continuing to build, suggesting that markets have pricing in that the RBA is likely to cut. Now, with these levels at this range, above 50%, increasing the likelihood even next month, a 56% chance of a cut, the markets are largely priced that in. So if you're someone who's going to say, well, you know, I think we should be short Aussie because the markets are expecting or are looking for an interest rate cut, that means that it's priced in already. That's not justification for a short. Okay. Now, if this was like the probability of a hike was above 50% or the probability of a cut was sub 50% moving into above 50, meaning more likely than not, then you'd see the market react. But with the broad consensus now suggesting that we're going to see a cut either next month or the month after, you start to price out, or you start to it would suggest that this decline essentially priced in this interest rate cut. That's all to say, guys, that if you read some of the headlines and you read some of the financial news publications, a lot of people will point to, oh, well, the RBA is expected to cut, therefore our broader outlook on the Aussie dollar is bearish. Just not always the case. Okay, if the markets have priced it in already, that's not, you know, a factor I'll take into account. So some food for thought there on the Aussie setup from last night. Okay. If there are other questions on the Aussie, let's move right on to dollar CAD. Another one I think panned out really well last night. I personally didn't get an opportunity to get in on this one. I kind of went to bed just as this thing was peaking. So it can be a little bit frustrating sometimes, but there's always more opportunities. Here's what the Aussie dollar, or dollar CAD rather, looks like now, and here's what it looked like last night. The basic premise of the setup we were suggesting is look for some near-term exhaustion here with basic trendline resistance and the 100-day moving average to contend with. That's exactly where we kind of capped out. Okay, if you bring this into the daily chart, there's that 100-day moving average, and there's basic trendline resistance. This is just from the near-term decline. Right here. Okay, so we did see a stall up there as momentum was giving us strong divergence, price action making a higher high, the oscillator making a lower high, followed by a trigger break, gave you the bias to move to the downside. Now this happened late last night, right around midnight. And again, that decline, you're looking for initial targets at the median line and at the 50% retracement. It's exactly what you got. Now, some pretty strong whip action here has us right back at the highs. Remember, the broader trade remains constructive above this median line here. So on a test of this key support region at 29.75, you actually had a near-term trigger, momentum turning right at 40. It's exactly what you want to see right back at the highs. So, Mike, that's all great and dandy, but what are we looking from here forward? Heading into the U.S. session, I think you possibly get another stretch higher. Now, if you're not already long, that ship has sailed. Kind of kicking myself now. And although, you had a great opportunity for the long. If you are not in this trade, I wouldn't be looking to chase here just yet. Topside targets, 130.52 would be the initial target, but I wouldn't even be looking to target that anymore as we turn just ahead of it a couple of times. I'd be looking to move into 786 retracement, takes you a little bit higher into 3058, excuse me, and then the 886 slash last month's open gets you 130.87 into 130.90. So you're testing some near-term resistance right now. I do like this thing higher. Possible entries, if you do get a pullback, are still going to be basically right around the same level. Sort of like something here would sort of be a nice opportunity to get back on the long side here for dollar CAD. Or if you do get the extended rally into the upper parallel, something right here might be, or the upper trendline resistance might be an opportunity to once again try to press the short. Okay, two things to keep in mind. Seasonalities for the dollar, as we noted a couple times already, are weak to start off the month. What was the second point I wanted to make? I just lost my train of thought, but it's one of the things you want to keep in mind. And second of all, heading into the upper trendline resistance here, keep in mind last month's open lines up perfectly with that right now, right around 130.90. Okay, right around here. One thing I also just popped at me, give me a second. I just want to see what this looks like. Wow, okay. So even the 618 retracement, look where it pops up, 131. Either way you look at it, major key resistance here near term for the loonie. Again, ideally you get the pullback here to get back on the long side for dollar CAD. We'll see if we can open up the session on a weaker note. As far as the CAD is concerned, remember Friday is going to be the big double whammy day. Those CAD employment numbers come out at the same time as non-farm payroll. Here's what that number is supposed to look like heading into Friday. We are expecting the unemployment rate to uptick from 6.9 to 7%, with a net gain of employment of just 5,000 jobs. Previous month gave us 13.8. Okay, so these are released at the same exact time as non-farm payrolls on Friday. So certainly the volatility can be extraordinary, specifically on a disproportionate print, meaning a strong NFP and a weak CAD data, or vice versa. So it'll be some really tricky trading situation on Friday, but certainly the volatility should be there. Barring, of course, they both come in much stronger or they both come in much weaker than expected, might have sort of offset itself. But when you get these double, which happens a couple of times a year, definitely, where you get the NFPs coming out on CAD employment report, you could see some real strong volatility. So keep that in mind if you're taking any longer term positions on the CAD heading into Friday. All right, so that is Aussie dollar, dollar CAD, euro dollar from last night's radar chart looks like this. Oh, and then we'll go over gold, which is just insane. Here's what Eurodollar looks like. I really don't have much to say on it. I like it bearish below the weekly open. Really nice clean break of the monthly open, a clean break of the initial weekly opening range low, and basic channel support really shifted the bias lower in the euro, at least from a near-term standpoint. The level that we reversed from, by the way, I know that Jamie pointed out in his report as well, but outside reversal off of a key near-term resistance. Now remember, the bearish invalidation level was 112.24 into 112.30. Okay, it was the 100-day moving average into 618. And a spike into that region would have been the gift that we were talking about yesterday, I think, for the entry. Long story short, the market has spoken. You posted an outside day reversal off of a major fib confluence. You have the lower median line parallel for the broader structure dating back to the 2015 lows. You have the current median line off the highs. You have a basic 50% retracement of the Brexit decline, and it really caught a nice outside day reversal, taking you back below the 200-day. Okay, now you can see the 50 line here is sort of wicking it. You're not able to close below it. You could get a pop higher. Again, I like it lower below the weekly open, with our bearish invalidation level now lowered from 112.30 to 111.70. Okay, here's what it looks like on the 30-minute chart. And again, here's what it was last night. So you saw a little bit of a dribble. That actually ended up being the low. We spiked a little bit lower beyond that and then turned, and it's sort of been a small, slow mutter higher. Look for some resistance here at 60 as we open up the U.S. session. If we do see a crack, again, initial entries or initial areas I'd start to look for re-entry are right around here, 111.25. Well, let me take that back. I'd be looking for triggers into 111, which is the monthly open, 111.05, 111.06. With our bearish invalidation at the weekly open. Meaning if we get back above this, I'm sort of not going to be shifting, or I wouldn't be looking for any short exposure from that point. But as long as we stay below the weekly open, I do like euro lower. And I think one of the major things that sort of made that judgment is what the daily chart did yesterday. Pretty big tell when you see something like this, especially when a strong reaction off of such a major critical confluence like that. Questions on euro dollar? Kind of breezed through that one, but there's really not much to say. You're looking for a rally to sell as close as you can to either the monthly open or the weekly open. Some of you might be thinking, well, hey, Mike, is there opportunity right now to try to get on a long into that region? Possibly. I really wouldn't want to take that route. Your stop would need to be against the overnight low, which is going to be, way out of the range of what we're looking for. But ideally, you'd be more or better suited from a probability standpoint to try to get a rally here to sell, as opposed to trying to play the rebound and then short. All right. Moving right along. Kiwi dollar was also highlighted in last night's update. Here's what the Kiwi looked like. And basically the break below the channel support and the high day close keeps the focus lower while below the weekly open. Very similar setup to what we're looking at in euro dollar, even cleaner on the ascending channel that broke here earlier in the week. Interim support targets at 77 and the 618 at 78.38. You haven't really gotten that downside pressure starting to pick up steam yet. Very similar again to what we just saw in the euro dollar. Thing kind of teetered out in overnight trade. So we did take out the high day close. Oops. And the initial support target at 77, or 70, excuse me, just missed by 9 pips. Okay, so here's the rebound. Again, the monthly open comes in at 71.30. Keep in mind our bearish invalidation at the weekly open right here. I think I tried this last night, but bear with me one moment. I want to see, does this have any merit to it? Could be. I don't know if I want to stress this formation here just yet, guys, but could be something in play. Either way, it's highlighting bearish invalidation at the weekly open, right, on a break of the upper median line parallel. So either way, I'd be looking at the same region for resistance, or just ahead of. Again, here's what dollar or Kiwi dollar looks like on the daily chart. And you'll recognize this chart. We were looking at this region here for months and months and months. I've cleaned it up since Market Scope, but really strong divergence, or excuse me, no divergence there. Where was, the trigger? I don't have it drawn here. Oops. Okay. Um, Really strong outside day reversal off of the March low day close. I know we've talked about this before. So if you take the March low day close, which was a multi-month low in Kiwi, you can see that last month's rally capped out right exactly there on a massive, massive key outside day reversal. Now, the subsequent rally pushed right through, couldn't even hold it for a day before, again, reversal day taking us back below the high day close, which is what we're testing as support right now. We do need to get below that on a close basis to clear the way. Keep in mind a few things. Not only is this the low day close, or excuse me, the high day close for the year at 71.18, basically where we are right now. Um, but you're also on this move breaking the monthly open, which comes in at 71.31, and an objective break of the initial monthly opening range low. So if we do close at these levels or below, preferably, it really puts the focus on some further downside pressure on Kiwi dollar. So I think it's actually pretty prudent to be constructive Aussie Kiwi just on the basis of looks like Kiwi looks like it has a lot more poised for the downside, whereas Aussie um, is in fact coming off of a decent support. For Kiwi dollar, we're looking for possible short entries on what rallies, but not the bearish invalidation level. So I like staying lower. What I noted in this last night, I like staying lower at below 71.20, 71.30, which again is the monthly open. The bearish invalidation level would need to be basically above 71.50. Okay, above that. Do you see this channel resistance, Eileen? I know that we broke through it twice already, but it's just a parallel off support. And we caught the highs that we made in early June. That's still the pivot I would use to invalidate the short side on the near term. Here's the 30-minute looks like. So initial area of resistance. I think this is too close. I don't know if this will be the cap, Eileen. That 50 area is going to be the bearish invalidation. Let's try this. Oh, come on. Any parallel action here? Nope. All right, so initial resistance 71.40, let's call it. Well, let me take that back. First, the monthly open. Look for some short triggers here. I do think you got some room and momentum, so I wouldn't be surprised to see this sort of rally into 71.60, to be honest with you. Um, Wait to see if 71.50 area to see if it invalidates. Yeah, ideally, Eileen, you get a spike into that region. One thing me and Jamie were talking about, I wouldn't be too surprised if the dollar show some pretty radical price action here today. Remember, we're just getting started with July trade. Quarterly opens are also in play, so there's a lot of inflow, capital inflows, and you'll likely see a lot more volatility as markets start to thin again right ahead of the NFP print. But I wouldn't be surprised if this thing does show us a nice pop into this region before turning over. Ideally, that's how I would play it. Sort of a little bit lack of conviction on this one, Eileen, which is why I have it on the radar charts for now. I do want to see a little bit more of a prominent resistance. I don't want to start just trying to run on the short train here, although I do like it lower. Inevitably you're reaching for, like I said, that 77, 70 region and 71.20/30. Yeah, right down here. The key 618 retracement as the targets for the downside. So let's see if we can't get some short triggers. Let's see what this looks like on the near term. Yeah, so you can see that the London opening range essentially broke to the upside a little bit deeper in the session here. So I wouldn't be surprised to see a new high post before it turns over. But the momentum signature has largely been pretty lackluster. Since the low in Asia, 60 resistance, 40 support, failure at 60. You know what I mean? If anything, it's a slightly constructive momentum profile right now in the 5 and 1 minute. So I'd be looking for a stretch higher either into 71.40 for possible entries or 71.60. Make sense? Okay, seems right. Patience. Thanks. Yeah, you're more than welcome. Yeah, be patient in this market right now, guys. There's a lot going on. So prudence pays, as I always say. All right, so if there are no other questions on last night's Kiwi radar chart, last but not least, definitely not least, one of the biggest players, the gold trade. Um, what can I say? This is such a big breakout, guys. If it does end up materializing on a closed basis, sayonara to the gold bears. They're gonna have a rough year. Here's what the daily chart looks like for gold. It's funny because we just published the quarterly forecast for daily FX, and we've already taken out one of the top side targets. Look, 1358 was such a critical region. It's not just because it's the 618 extension off of the lows that we made last year. There's the reference points for that extension. Boom, boom, boom. That's not only why. It is also the one. Whoop, it's also the 1618. Okay, sliding parallel of the entire ascending structure. So if you look at this structure here for this ascending median line formation off the lows, which I just moved. Let me lock that. There it is. Um, this is a 1618 extension of the parallel. Okay, from the lows that we're looking at here. You have 2011 trendline resistance. Okay, dating back to the all-time record highs that we made in 2011, right around 1920. And you also have that 1618. So all three of those converge right at 1358. Today's breach, if it is a close above this region and momentum does in fact close above 60 for the first time since February, that would be as bullish as it gets. Initial targets are 1380, you're almost there already. And then a basic embedded channel. Now, I know this channel here is kind of messy on the chart, but all this is basic trendline support off the lows. Take a parallel of that off the highs from February. And that's your first initial target beyond 1380. So that's like basically right today would be 1400. Subsequent targets at 1433 and 1456. That's basically the magnitude of a rally that you could potentially see in gold if it holds above 1358 as support. At this point, I'd like to stay constructive on the trade while above this sliding parallel here, okay, which is basically just above the monthly open at 1321. I know that seems like a far away from where we are right now, guys, but gold has been making $50 rallies on a daily basis over the last couple of weeks. It ain't nothing. All right, and a break above 70 here certainly has the potential for a continuation higher, as we saw back in February. So don't put it past this thing. Don't try to get cute and try to call a peak on this. Initial 1380 would be the first initial area of resistance. You'd start to look for some pullback to possibly get back on the long side for a stretch into both channel resistance and that 828 2013 high. Again, a trade that's very much attributable to not only the risk-off trade, but gold will also catch a bid when interest rate expectations get kicked out further, right? As interest rate expectations get brought forward and people are saying, hey, well, the Fed's likely to hike, well, if they do hike, remember, gold doesn't pay you a dividend. There's no rate return. So there'll be that inherent want to move into the world's currency. That being said, interest rate expectations going down, the toilet at this point. It's, forgive my lack of better words, and also the risk-off environment that you're seeing aside from all these central banks essentially rushing to ease the most. You got negative rates in Switzerland, negative rates in Denmark, negative rates in Japan, expectations for lower rates now from the BOE. Remember, you had Carney come out earlier this week and basically say likely going to be some interest rate cuts moving forward this summer from the Bank of England. Now, if we look at the credits or overnight swaps rather for the UK, United Kingdom, you can see the probability of a cut next month is already, oh, that's this month. The probability of a cut this month, when is the next BOE decision? On July 14th. In case that'll be next week. But certainly the expectation for a cut this month is already at 70 some percent, 76%. Remember, this is a record low for the UK as far as interest rates are concerned. So they're going into uncharted territories here. Anyway, I digress. Sorry about going backwards there, but interesting tidbit there as far as expectations from the BOE as well. Any questions on gold? Could see some decent volatility on non-farm payrolls, especially on a miss type of scenario, both on the upside and the downside. If you see a real strong print, look for this thing to spike into channel resistance, and a possible short from there back into support might be a really nice play here. That being said, you're looking to buy pullbacks constructive above 1358, bullish invalidation at 1321. Mir says, SPX 500, coming right up, sir. Here's what the SPOOS looks like as it stands now. Just taking a quick look at this last night, I really don't have anything as far as a trade setup. I think the levels are clear. Is it an actionable? Whoops. Is it an actionable plan that we can actually get a trade set up? I don't think so. You're basically looking at the opening range high for the month coming right in line with this near-term upper median line parallel. Now, you don't have too much conviction on this formation being the slope or the gradient of the market at this point. Obviously, you saw a probe through the lows. The median line hasn't, on a closed basis, has been clean, but hasn't given you too much. Long story short, the yearly open for 2016 comes in right here. The 50% retracement of the Brexit recovery comes in just lower at 2050. The 100-day moving average comes in right in that region between both of those over the next few days. So all I can tell you is for SPOOs, this is sort of the major key support region near term I'd be looking for. I'd be looking bearish sub 2112. You had a real stern and very quick rejection of 60 on the Brexit rally. The Brexit decline took you well below 40. I would discount that just on account of the emotional trade we saw those last 2 days. But here we go again, turning ahead of 60. Price holding and turning well ahead of the record high day close that came in, what was that, back into 2015 at 21.25. All right, Mir, does that help? Do you have any specific questions on the SPX? He says support at 2057. Yeah, that'd be the initial area. Yep, at least for me. Yeah, any way you look at it, Mir, this is a pretty big region. Not only is it the yearly open, you got the 100-day, you got the 50. There's a lot going on there. Yeah, this would be my first region. I'd expect to see some support here. There you go. Feel free to take a picture of this, Amir, if you need. Again, a quick reminder, camera button, top right-hand corner, if you want to take a snapshot of any of the trades that we're following here. Yeah, you're more than welcome, man. Appreciate it. So that is the SPX. We went over pound yen, gold, oil. While we're at it, here's what oil looks like. I do want to just highlight a couple of things. Oil is coming into range support, which is basically well defined by the open for, what month was that? May. It's interesting. The May open has continued to offer a very decent and strong pivot in price. That's right around 45.98. Excuse me, essentially the 46 handle. You saw that pivot break of the opening range back last month. Obviously, that gave us an upside bias right into the highs of the month. Last month was sort of a wash with just the opening range never actually giving way. Here's that support catching all the lows last month and again catching it now. Okay, so look for some kickback. I want to stay bearish below the monthly open, looking for a breakdown essentially to 44.68. This is the region of which if you break, there's likely to be a lot more downside. Okay, remember, we broke the downside of this ascending channel formation. It tested it as resistance on the break. And again, these things, if they do break lower, you'd look for a break below 44.69 to really give you the spill. The first sort of target would be a soft target at 43, the low from May. But more importantly, this key region here, 1618 extension off the high and a basic 38.2 off the low gives you 41 into 41.86. So first things first, I'd like to stay bearish below the monthly open with a break below near-term support at 46, targeting these major key targets on the downside. Okay, that being said, we are at range support right now. Okay, so don't be surprised if you see a little bit of a pop here higher in crude over the next few hours. Questions? Although markets are trading pretty heavy before the open or ahead of the open, here's what the equity indices look like. Okay, Europe's down 1.72%, FTSE 100 down 1.45%, CAC down 1.7%, DAX worst performer so far in the majors, at least down 1.78%. If you take a quick look at equity futures, Dow Jones down 86 points, S&P down 10 handles, NASDAQ down 24 handles, and this is even ahead of the open. Okay, so markets are trading on a little bit more of a risk-off footing to open things up. Bearish on crude, sub the monthly open, looking for that run into key support at 44.68. Any questions on the crude trade? Again, nice rejection here on that break below the channel support. Nice rejection right at 60. That's exactly what you want to see. All right. If there are no other questions, we're going to go ahead and wrap it up here. Thanks for everyone who attended. We'll be back on board tomorrow for another intraday strategy webinar at 8:30 Eastern. A quick reminder, Jamie's midweek strategy webinar has been pushed back till tomorrow, same time at 1 p.m. Obviously, we're going to get the release of the FOMC minutes, and it makes for a little bit trickier of environment. He wants to be able to really get to focus on those setups that have been covered on the swing update. So we'll push back the midweek strategy webinar till tomorrow at 1 p.m. Eastern. It has been updated on the homepage since yesterday, and we will see you tomorrow morning. Eileen, thanks for that. Mir, Mark, Medad, see you guys all tomorrow. Best of luck trading. Cheers.